Hey, how's it going, guys? Welcome to the Module 2 of Options Trading Foundation, the complete options trading course for beginners. Module 2 is all about options risk graphs. Knowing how to use options risk graphs is probably the single most important skill for every beginner option trader because it is the bridge that takes you from your options trading basic knowledge, which you will cover in Module 1, to the real option trading strategies designing and execution. There's three different sub-modules in Module 2. In this video, we'll start from the submodule 2.1 and help you guys understand what exactly is a risk graph. Alright, let's get started. So what is a risk graph? A risk graph is a two-dimensional graphical representation that shows the range of the potential profit and loss for a trading strategy. There are two axes in a risk graph. The horizontal x-axis represents the price of the underlying stocks, and the vertical y-axis represents the potential profit and loss. This is why some professional traders also call them the profit and loss graphs or the P&L graphs. They provide an easy way to visualize and understand how the underlying stock price movement affects an options trading strategy's potential return. There are three possible scenarios where a risk graph can be used to show the potential payoffs. First, and also the easiest, the one single option trades. Second, the pair trades. These trades involve two options, usually in the opposite direction. Third, the complex option combo strategies. They usually involve three or more than three options in one trade. In this entire module 2, we'll start from the most basic and the easiest, the one single option risk graphs. Then in the entire module 3, you will learn how to draw the risk graphs for those popular pair spread trading strategies with two options. And then we will move on to some more complex option trades in module 4 and then learn how to draw risk graphs for those strategies. For every beginner, if you wish to trade options successfully, you must have a solid understanding and skill to visualize the potential profit and loss for any trades you want to take at any given time as the underlying stock price moves. The best and the fastest way to tackle it is to learn how to draw a risk graph each time before you put on a trade. This is extremely important. It's very similar to those technical traders who always set a stop loss before they put on a trade. If you have gone through my entire technical analysis trading course, you probably still remember one of the things I mentioned the most was that the best time to set a stop loss is before you put on that trade. And for options trading, drawing the risk graphs is exactly the same thing. The best time to draw the risk graph for your trade and visualize your potential profit and loss is before you hit that trade button. This is something I really want to highlight here. If you're already a pretty advanced options trader, drawing those risk graphs and visualizing the potential payoffs have already become a second nature or a muscle memory for you. It won't take much effort for you to draw the risk graphs when you put on a trade. But if you're a beginner who just started out, then you have to be patient and take as much time as you need to draw the option risk graphs every single time before you put on a trade. Not only it will help you make consistent profits in options trading, but also drawing risk graphs is the single best and the quickest way to improve your options trading skills and to take you to the next more advanced level. Based on my own experience, when I started out, I benefited the most from learning how to draw risk graphs for every single trade I put out. It truly accelerates my learning curve in options trading. That's why you guys are going to see a lot of risk graphs in this entire course, and I will make sure to go through each one of them very slowly so you can fully understand. Alright, let's move on. When it comes to risk graphs, there's one important thing we have to talk about, is the break-even price. In options trading, the break-even price is the underlying stock price at which traders can choose to either exercise or dispose the option contract without taking any loss. Or you can also look at it in this way. Break-even price is the price where the underlying stock must hit in order to fully cover the options premium. Some traders also call the break-even point, but they basically mean the same thing. These are the formulas for calculating the break-even price. For call options, break-even price equals to the strike price plus the premium paid. For put options, break-even price equals to the strike price minus the premium paid. Let's take a look at one example. Let's say you bought one company XYZ December 2020 call option at a $30 strike for a premium of $2.50. So the break-even price for this trade is 30 plus 2.5, which is $32.5. When XYZ stock price moves above $32.5, you will have profits. When the stock moves below $32.5, you will have losses. Alright, without this, let's draw some risk graphs. Before we jump into the options risk graphs, let's start something really basic, directly long and short underlying stocks. First, we have the x-axis, which represents the underlying stock price. Then we have the y-axis, which represents the profits and loss of this trade. So for directly buying a stock, the risk graph line is simply a straight line because your potential payoff is linearly dependent on the stock price movement. The break-even point will be the intersection point of your P&L line and your x-axis. For the simplicity purposes, we do not consider brokerage commission fees in this entire course because each brokerage may charge different fees and those fees are usually insignificant. So for this trade, your break-even price will be simply the total price you paid for owning the stock. Apart from finding the break-even price, another important key features of a risk graph is to visualize your potential maximum profits and the maximum loss on your trade. For example, for this long stock trade, the potential maximum profits is unlimited because there is no ceiling for how much the stock price can go on the upside. But for the downside, the potential loss is limited to $100 because the maximum downside for the stock price can go to is 0. So your maximum loss for this trade is $100 with unlimited potential profits. Alright, now let's take a look at another risk graph example, directly shorting stocks. Let's say instead of buying a company XYZ stock, you believe the stock price will go down and decide to short this stock at $100 to make profits. So this is the risk graph for this trade. Your P&L line is inversely correlated to the stock price movement, meaning when the stock price goes up, your potential profits will go down. The break-even point is at your short selling price, which is $100. When the stock price drops below 100, you will make profits from this trade. But when the price goes above 100, you will have losses because the maximum downside for the stock price can go to is 0. So your potential profit will be limited at $100, but your potential downside risk or potential losses from this trade will be unlimited. Alright, these two are the easiest and the most basic risk graphs to help you guys understand what a risk graph is all about. Next, we'll move on to the options. There are 4 basic option trades and their risk graphs: long call option, short call option, long put option, and a short put option. I will stop this module right here because I wanted you guys to try to draw the risk graphs for these 4 most basic option trades by yourself first. It is okay if you make some mistakes, but it's very, very important that you guys try it on your own first before I share with you the answers. In the next 2 sub-modules, we'll go through each one of them one by one with the real-life trade examples and the case studies, and show you guys how exactly the professional traders apply these basic trades in their options trading. Alright, that will be the end of this module 2.1. If you are new to this channel, my name is Vic. I hope you guys enjoyed the course so far. If you find my contents have been valuable to you, please consider subscribing and helping me click the like button on this video. It can really help reaching out to more people who need this content. Also, please turn on that notification bell so that you will never miss any module in the future whenever I upload. Again, thanks so much for watching guys, and I'll see you guys in the next one. Bye for now.